Well, in connection with low-value items, the IASB certainly was considerate of their users and our viewers, weren't they, Peter?
There's good news and bad news, Mike. There's the IFRS approach, and I think the IASB felt that they didn't want to create nuisance accounting here, because there are a lot of leased items that are leased simply because they are nuisance items. Nobody wants to maintain a cell phone inventory when they can be leased and thrown back at a lessor for next time the revolution comes and you need a better photograph. There are photocopiers everywhere in the universe that are generally not very expensive, often held under lease, partially to make sure you get the latest technology and you're not tied into some ancient creaky machine. There are laptop computers. The technology constantly changes. Every salesperson or professional needs one. There are gazillions in organizations. They're often hard to take a hold, get track of. But frequently, these are also held under lease. Now, technically, I can see where for some organizations, I think of professional services firms. What do they have? Office leases and laptops and a bunch of employees. The laptop may be the biggest asset on their balance sheet when they capitalize it. And, that could be more than a couple years lease, turn them over, a lot of software in there, internally developed, which is a related but somewhat different issue. The IASB's approach is to try and detrivialize this issue by saying that low-value items do not have to be included in the standard. And they didn't specify what low value is. The number $5,000 is kicked around. I find that interesting. Is that translated into 6,300 Canadian dollars or euros? How many euros? That depends upon the day, perhaps, as to what that means. But I think they were looking at that threshold of transaction size where enterprises are somewhat indifferent in the normal course of business between expensing and capitalizing. And that there's tax practice that governs that as well. How you need to depreciate that. Can you have to put it in a pool, or can we just expense it? So the IASB explicitly recognized that low-value items, as measured by the item, not by the materiality to the organization, are out of scope, as well as leases less than 1 year. The FASB did not include a low-value item exclusion. I can hear the argument in my head as you may have a couple $100 million low-value items and you have a material amount, and I don't care if it's $1 or $5,000 times $1 million, you've got something that is possibly needs to be accounted for, and we cannot make generic statements. So there was a different compromise. I think it's an interesting contrast in standard setting styles. That the IASB did not compromise, if you want to call it that way, on the cash flow issue and recharacterize the cash flow, but did offer a low-value item exclusion. The FASB, on the other hand, did not offer a low-value item exclusion, but did not change the cash flow characterization.